Hello everyone and welcome back to another video. Please do consider subscribing if you have not already, and be sure to check out my other stock analysis videos just like this one. Please do consider subscribing. Alright, let's get right into it. This is Wendy's. Yum yum yum. I just had a Frosty last night. Love a vanilla Frosty. It really does hit the spot. I have heard many people say that the Wendy's chicken sandwich would have, beat the crap out of Popeyes and Chick-fil-A when that whole thing was going on. Their spicy chicken sandwich is very good, and it is nothing to sleep on. So, with that being said, let's get right into some stock analysis of Wendy's. So, Wendy's on Tip Ranks has a very high analyst rating. 13 buys and 9 holds. So it's out of 22 ratings, it's a moderate buy with a 14% upside. Recently, this thing just took a absolute moonshot and was, I think, close to 30. It took over as a meme stock, and that's unfortunate because Wendy's is just, an empty vessel again out there. It's nothing. There's nothing meme about it. So anyway, there's a $26 price target on it, which is very reasonable as like a fundamental price target, not a meme stock price target. So with that being said, the analysts overall say that Wendy's is a 9. It's an outperform, and I really like Wendy's. Like, I used to own it, and I might just buy it again. I might buy more shares of Wendy's. I used to own quite a few shares. It does pay a dividend as well, which is really great, and it's like the cheapest restaurant stock, like out of like the Chipotle's, the McDonald's, the Burger King's. Like, it's the cheapest one, and it's really like I bought it. I bought the some shares back when they had first announced that they were going to go through with having breakfast. And it's like, okay, well, you're adding a new menu item. You can only make more money off of that. So let's just see. Let's see the income statement. So Wendy's fiscal year ends January 3rd, 2021 for the 2020 year. So as we can see, they had their highest, well, their second highest since 2015 year of revenue. So that's pretty good. They're climbing their way back. They're, on the up and up. And we can also see that they have net income that is 117 million. That's pretty good. That's about a 10%, a little bit more than 10% net income, which is pretty good for a restaurant. Remember, it's really hard to make a profit in restaurants and in the food industry. If we go over to the balance sheet, we can actually see that Wendy's, again, is at a pretty strong and pretty even cash holding, so that's good. That's good to see. And their total current assets is the most it's ever been. So Wendy's has just been building up those current assets, and versus their current liabilities, it is bigger. So they have good working capital, and they can meet any current demands that they might face. Long-term debt, they do still consistently have about 2.7 billion. Looks like this is planned to have it to be like this. So that makes sense why there is 2.7 billion. They don't really pay down debt. We'll actually look into that. And anyway, total assets is 5 billion. Total liabilities is about 4.5 billion. So they have about 500 million more in assets. If we look at the cash flow statement, we can actually see that it starts off with the net income. And if we go down here to the financing activities, we can actually see that they do issue long-term debt, but they also make almost as much as they issue long-term debt. They repay almost that same amount, if not a little bit more, most of the time. So that's good to see, as long as they're paying down the debt. And then they probably, if they're going to become a meme stock, they should probably start issuing more equity just in case, because that's a good cash raise. They can then buy back their shares if they happened to fall after issuing more debt when or more shares when the meme stock phase goes away. They can actually come out on top and do pretty well if they took out a loan against themselves and issued more equity to gain cash and then use that cash to buy back more shares at a lower price. Just saying, it could go very well. And they're also not, they've actually lowered their dividend a little bit, so they're actually kind of stingy, but at least they do pay a dividend, so that's a good thing to see. If you had invested $10,000 in Wendy's at its IPO in April 1992, we actually have results from January 1993, and it's not that great. I mean, it's a restaurant, again, it's about 7.25% compound annual growth, and that's not incredible, but if we actually look at the annual returns, we can see that Wendy's has had, a solid 2019, which is when I invested in them. Pretty meager 2020, probably because of, the pandemic, and then a good start to 2021, about halfway through. But in the last few years before that, even, Wendy's has really taken off since 2013. They had a bunch of down years all throughout the great financial crisis, and it's been nothing to sneeze at. So if we actually start this by investing in 2013, the same amount, $10,000, let's see what we would come up with today. See, now it went from 7% if you started it in January 1993 to $59,000 total balance for about 23% compound annual growth rate. That's really good for like a restaurant. You again would think that a CAGR of 23% is like a tech company since, January 2013. So anyway, this is just what I want to show you guys. Hope you guys do enjoy this video, and please go like and see my others.